What's up, guys? Back with another video today, and today I'm going to be talking about market risk, and then we're talking about yields. So let's get into it. So starting off with market risk, we're going to talk about bonds again. And yes, bonds was a very challenging, or not challenging, but a very sensitive or detailed topic. So let me just break it down really easy. So when a bond is issued, that is a debt obligation a company will have to repay back for its interest rates, okay, the coupon rate, and the principal when it's called a maturity. So let's say that you're in a debt obligation with a company, and the default risk factor is that the issuer of that bond cannot repay that interest, nor they can repay the bond principal. So what happens? Well, when they file bankruptcy, or if they file bankruptcy, but that's usually the case, they will have to pay off the creditors first. Now, if they just pay off the creditors, then oh well, it happens. But that's the risk you're taking when investing. Not everything is 100% guaranteed. Unlike the default free bonds, and I put that in air quotes because nothing's perfect, but risk-free rate, aka default-free bonds, are the treasury bonds because they are backed by the full faith of the U.S. government, who can either raise taxes to pay off its obligations or print more money. So basically, you have more trust in the government knowing how to handle their debt obligations than an actual corporation that can go bankrupt, pay its creditors, but may not pay off your bondholders and or your shareholders, which are shareholders. They're not entitled to anything, but if you have people with dividends from the preferred stock, or if you have bondholders, you will really want your money. Now, that's the risk of corporations, whereas the government, they can, like I said, raise taxes, print more money. So that's what happens. So default risk is pretty, I guess, high around this time because when the pandemic started, a lot of people were scared that things are going to fall through. A lot of people are scared today that banks are going to fall through because of insolvency, but I can talk about that in another video. However, just understand when you're investing in something, there is default risk with debt obligations. So if you invest in the corporation's debt obligations, then okay, you are taking a higher default risk than investing inside of government bonds. Because like I said, the government, you got more trust in them to actually print more money. And obviously you may hate that, or raise taxes, you may hate that as well. But knowing that the government will pay you off rather than have a corporation go bankrupt and may or may not pay you off, that is something you want to think about. Let's get to risk premiums. So the risk premium, which is the spread between interest rates on bonds with default risk and the default free bonds, it's how much an additional interest people must earn in order to be willing to hold that risky bond. So what did I just say? So let's look at supply and demand first. So let's say you have on your x-axis, you have your quantity of bonds, how many bonds you have. And then on the y-axis, you have your price of the bonds. So you have price and then you have quantity. And obviously, if you've taken any economics or finance class, we know supply and demand about left and right shifts. So let's say you have an increase in default risk. So everybody's scared that, man, we're going to default. They don't have the money. The demand curve for corporate bonds will decrease because corporate bonds, as I said, are more risky than the risk-free bonds or default-free bonds of the U.S. government. So if you would like to invest in any bonds, if you feel like you want to go safer rather than go more for compensation, then not advice, but I'm telling you, the true option is to go towards treasury bonds because they are backed by the U.S. government. Simple as that. So the demand for corporate bonds when there is a increase in default risk shifts to the left because nobody wants to go for something that's more risky. But if you have a shift for treasury bonds when there's an increase in default risk, it goes to the right because they're safer. So like I said, price of the bonds, quantity of the bonds. You will want more safer things, so the demand increases for the treasury bonds, whereas the more risky ones, the corporate bonds, go to the left because nobody wants to have anything that's risky in their portfolio when there's default risk looming. Okay, and that is what we do for our bonds. Now, another thing I want to talk about when it comes to risk or yields, let's talk about how treasury bonds, they pay federal tax but not state or local. Treasury bonds, we're not talking about notes, we're talking about bonds. We're not talking about bills, we're talking about bonds. Treasury bonds between 10 and 30 years, they pay federal tax but not state or local. Corporate bonds are fully taxable at all levels. Now, we're going to talk about municipal bonds. Municipal bonds, I could make a whole nother video on that, but just to touch the basics of it, municipal bonds are bonds or debt issued by state and local government entities for schools, sewer systems, authorities, and the state itself. So I have three different bonds that I'm gonna go through, and I'm gonna keep it simple, keep it short. You have general obligation, revenue, you have notes. So GO bonds or general obligation bonds, they are backed by taxes. Keyword, they are backed by taxes. So whenever you have a general obligation bond go through, it's backed by taxes. It's issued for facilities that benefit the public. Keyword, benefits the public. General obligation is for everybody. So it's for the general public, which means that they don't want to be a revenue bond. So they don't really care about revenue. They care about helping people. It requires approval from voters. So it might be on your ballot. And has a statutory debt limit. There is no flow of funds provision, and there's no protective covenants of it because it's not revenue bonds for everybody to use. So anything that people can use for the general public, that is a general obligation bond. So it's backed by taxes, whether that comes from income taxes, real estate taxes, or sales taxes. Now we have a revenue bond, revenue municipal bond. It's backed by user charges. So let's say they have a new toll road. They're building a Selman Expressway 2.0. Yeah, that's going to pay for the expressway itself because everybody wants to get somewhere faster. So it's backed by user charges. So if they build a new toll bridge and they increase the limit, like the one on I-4 somewhere heading towards Orlando, where it says it depends on how much traffic's on there, that's how much you get charged. That is because those projects take millions of dollars, if not sometimes billions, to be able to create. So how are they going to make that back? By charge you a lot of money, but you said, well, I'd rather get somewhere 20 minutes faster than have to wait in traffic all day. And that's cool. If you can afford it, you want to pay it, cool. You can do that. But just remember, that's how they make their money back. That's a revenue municipal bond right there. Toll bridge, airport fees. So that toll bridge that you're using, that could be a municipal revenue bond. Airport fees, municipal revenue bond. It's not really for the general public per se to help you guys out. It's to make revenue. They can be backed by licensing fees, lease payments, and special taxes, excise and excess taxes. They're backed by protective covenants, and the protective covenants are for those revenue bonds only. And the flow of funds provision determines the priority of incoming revenues. So the main thing to understand between GO bonds and revenue bonds is that one, the GO bonds are backed by taxes and they're for the general public to use. So that means they don't care about having revenue in the long run. They just want the general public to use something. So that is mostly like, I guess, transportation in a way. Revenue bonds, they are your toll roads. They are your airport fees, but keyword toll roads. If there is a multi-hundreds of $1 million project for a new expressway, the state or the city, whoever issues it, but it's issued by state and local governments, but let's just say the state issues it, they want their money back. And if you guys complain about taxes or income tax being raised, they're going to do it on the toll bridge. And they know everybody, if you have a Sun Pass, Easy Pass, or No Pass, they will get you. That's why it costs more for you with a license plate without a Sun Pass or Easy Pass sticker to cross the toll bridge than for somebody that has it. So it's like a subscription. You subscribe, you get yourself an Easy Pass, a Sun Pass, then you pay less for the revenue bond. But if you decide to just say, screw it, I'm going to get it in the mail, they're like, okay, you don't want to subscribe to our service, you pay more. And that's how they get money back. Because some people say, it's inconvenience for me to go to the store and buy this transponder and hook it up. Yeah, I bought one. That's just my personal experience. I would say if you use the toll bridge all the time, just buy one. Buy a sticker, buy a transponder, do something, because that's how they get more money out of you. And a note, municipal bond note, short-term maturities is used for interim or temporary financing. So it's just for anticipation notes such as tax, revenues, bonds, etc. And that's for municipal bonds. So the main thing I want to talk about this with municipal bonds is that the tax-free statutes shifts demand for municipal bonds to the right, treasury bonds to the left, because you have a y-axis of price of the bonds and the x-axis of the quantity of the municipal bonds. So because tax-free statutes, it shifts them to the right, because municipal bonds, if you guys didn't know, it says right here, municipal bonds, you don't have to worry about that. Whereas treasury bonds, well, you have to worry about that because they pay federal tax. But municipal bonds, you don't have to worry about that. And it says also the longer the maturity, which we're about to get back into maturity again, of the yield for bonds, the higher the rate. Now, if you guys know, price and yield have inverse relationships, because if there's the higher the price of the bond, the lower the yield. The lower the price of the bond, the higher the yield, because of things may be outdated sometimes whenever rates go up. And let's talk about the yield curve to end the video. So the yield curve is typically sloping upwards. So it looks like it's exponential growth going this way. And yield curve, inverted yield curve is the #1 predictor of a recession. So back in fall of 2021, when I was a senior in college, my senior year, my first semester, we talked about this all the time. Are we going back to recession? People ask now, banks don't solve it. SVB went down. So are we going to have a recession? We don't know. Now, back in college, we did a yield curve and analysis, and the analytics showed that it was sloping downward a little bit. So, are we going to recession? I didn't say anything. I don't know. All I got to say is you just got to be watchful. You got to study on this. Do due diligence. So, let's talk about how yield curves should look, or how curves of yield should look. Let's go. Yield to maturity on your Y, your X is the time to maturity. So when it's steeply upward, your future short-term interest rates are expected to rise. When it's trending downward, your future short-term interest rates are expected to fall sharply. And when it's flat, that means future short-term interest rates are expected to fall moderately. So basically, a mildly upward sloping curve means that future short-term interest rates are expected to stay the same. So the best thing you can get from this whenever looking at yields is that you want to buy your short-term bonds when you feel like rates are going to be higher for you. Whenever you feel that rates are going to be higher, you might want to go and get the short-term bonds. The long-term bonds you don't really want to get because they're more susceptible to being hit by interest rate fluctuations. So the longer the term you get, the more likely you're going to be hit. So if you feel like rates, depending on if you get a discount bond or if you get a premium bond, it depends obviously, but short-term bonds you might just want to stick to because they'll be easier to track. Whether it's long-term bonds, you have to face interest rate fluctuations. So that's the end of the video, guys. Thanks for watching. I tried to keep it short, but I kind of just went on a tangent, making sure you guys got a lot of information. So thank you, guys. Please tune in next time.